Good morning. Welcome to today's webinar. So today we will present on two companies in Asia. One is China Sunsine Chemical and the other one is Y Ventures Group. And also we will give company results updates on different REITs. Firstly, we will present on China Sunsine Chemical. Our title is Catch a Right Time to Expand Production. So we initiated with a buy call and a target price of $1.60, and our forecast dividend for FY18 is 2.6 SG cents, and the last done price was $1.11. So there are four main selling points for China Sunsine. Firstly, China Sunsine is the market leader in rubber chemical industry. As of now, it is commanding 18% share of the global production. Sunsine is also the largest rubber accelerator producer as well as insoluble sulfur producer in China. Secondly, we expect that Sunsine can maintain its profitability as over the years it managed to deliver a stable profit margins. The reasons for this is because we think that the market spread, which is the rubber chemicals selling price minus the cost of materials, that can be sustained in the next couple of years. The third point is with the tightened environmental policies in China continue, the market will gradually phase out smaller producers in this sector. As a market leader, China Sunsine is expected to gain more market share in this niche market. The last point is the company has planned to ramp up the capacity. According to the plan, they will ramp up to 117,000 tons by 2020. Now here I will explain a little bit about this sector because this is a very niche market. So what are the rubber chemicals? They are also called rubber additives. It is a kind of ingredient used to blend into the rubber production to enhance the properties such as anti-oxidation, anti-degradation, and the extension of lifespan. So all in all, that means in the process of rubber production, rubber chemicals must be added into this process. And the raw materials to make these rubber chemicals are shown here. And among all these materials, aniline is the main materials. That means the price of aniline can substantially impact the price of the cost of production of rubber chemicals. And also the demand for these rubber chemicals is quite closely related to the automobile industry. As we can see that 70% of the output is used for the production of the car tires. And here the consumption ratio of rubber chemicals to rubber is 6 to 100. This chart shows where the rubber chemical sector sits in the supply chain of of this rubber and rubber related industry. So these are the three major product categories of rubber chemical, and also these are the China Sunsine's main product mix. The next is the company background. As I said earlier, China Sunsine is the market leader in this industry, and its major product includes rubber accelerators, antioxidant, and insoluble sulfur. Its client base has been more than 1,000, and among these there are 65% of the top 75 tire producers in the world. Its headquarters and production plants are located in Shandong province, and by 2017 its total annual capacity reached 152,000 tons. So why we are interested in this sector? Because it is a very niche market. As you can see here, China has become the biggest rubber chemical producer in the world. So since 2013, the domestic production surpassed 1 million tons, and China had taken up 70% of the global market share. And over the past 4 years, the China's market share in the world has been maintained at around 75%. And the next interesting sign we should take a look is the consolidating market trend. So you can see here the top 5 companies in this sector accounting for more than 40% of the whole industry sales. So China Sunsine is ranked second place among these top 5 companies in terms of sales as of 2016. And also the 80-20 rule perfectly apply in this industry, as the top 20 companies out of 100 market players actually accounted for more than 80% of the market share. So since the demand driver comes from auto and tire industry, we should analyze what's the trend of what the tire industry trend is in China. So you can see the chart here. China has become the fastest growing countries in auto industry. So over the past 10 years, the growth of China's car production actually outpaced the whole world's growth rate. And also the global production of tire is expected to have a CAGR of 3.4% from 2017 to 2020. And also the growth of rubber chemicals production is actually in line with the growth of the tire production growth. So there are 2 main factors to drive the rubber chemicals price up. Firstly, as of now, the market in the rubber chemical market is still facing supply short. Why? Because in China, in the beginning of 2015, the authority enacted the new environmental protection law, and this law caused a widespread shutdown for those plants and factories that fail to meet the environmental standards. And also, beginning in 2016, China initiated the supply side reform to phase out the environmentally obsolete capacity. So these two policies actually reduce a lot of the capacity of rubber chemicals in this sector. So the second point, the second factor is the cost of the increase of cost production. As the chart here shows that the upstream aniline price in 2016 and 2017. So you can see that the domestic price of aniline increased by 131% since January 16. So we think that the existing market leaders will continue to consolidate the market. So these are the main three reasons. The first one is that the stringent environmental requirements will raise the entry barrier and restrict the new capacity of the production, and also will continue to phase out the smaller players in China. And secondly, for those top tier producers, the cost of switching supply source of supply is high for them, because when they try to secure a supply contract with these rubber chemical producers, they need to conduct the due diligence to make sure these suppliers can meet their standards, especially of environmental protection and product specification. That means not every rubber chemical producers can fit into the their standards of this. And also these top producers, they have the cutting edge of production techniques and the stable client base, as well as the better ways of processing. So the next point is we think that it is reasonable to project that Sunsine can maintain the margins moving forward. So over the past 10 years, you can see that the companies maintain a gross profit margin at above 25% averagely, and for net profit margin, it maintained at around 10 to 11%. So here the dip in 2012 and 2013 was because that time the sector encountered the overcapacity. That means even like Sunsine, this kind of market leader, will face intense competition within the market. So that time all the market players experienced the price war to fight for the businesses. So here we analyze the market spread during this period, you can see that Sunsine's GP per ton actually checked the trend of the market spread. Here the market spread is the sales price of the robust accelerators minus the price of aniline. So the third point is very important for China Sunsine, because over the past 10 years, it has been putting efforts on environmental protection, and in recent years, these efforts are finally pay off, because it survived and thrived during several rounds of the inspection from the authority as well as from the tire producers. So this is the ramp up of capacity plan until 2020. So in this year, there will be another 10,000 tons of TPPS capacity, as well as another 10,000 tons of insoluble sulfur capacity to ramp up. So here are our assumptions. So we used capacity weighted average price and expected sales volume to derive our revenue. Because China Sunsine doesn't have bank borrowings, so we use FCFE to evaluate the company. So we initiate with a buy call and a target price of $1.60 for FY18. Here is a peer comparison and investment risk. So far, there is only one listed coal, Yanggu Huatai, in China, considered as the peer of China Sunsine. So it is worth noting that the Yanggu Huatai is trading at a PE of 24 times, while Sunsine is only trading at less than 10 times PE. So these are the risk factors that can significantly impact on the operation from the company. So it is very important to know that the major risk comes from the policy side, as we know that over the past 2 years, China has been conducting a very stringent environmental inspection, especially for those petrochemical industries and used and previously polluted industries. So we think that moving forward, it will be subject to a frequent environmental inspection, which may cause temporary stop work. So let's recap. So we initiate with a buy call and a target price of $1.60, and China Sunsine will maintain its market leading position moving forward and its stable profitability. And the stringent environmental policies in China will actually benefit the company since as of now it meets all the requirements and standards of the environmental regulations. And also it will expand its production by a third to 117,000 tons by 2020. Next, I will pass on to Alvin to talk about Y Ventures Groups.
Hi, good morning everyone. I'll be commenting on behalf of Paul today as this is not in now. Okay. So to give you a little bit of background, it was recently listed on June 2017. Y Ventures is a data analytics, e-commerce, retailer and distributor. So initially when we decided to write about Y Ventures, we were thinking that it's nothing interesting. It's like e-commerce, retailer and distributor, but actually they use a lot of data analytics in their core business. They use data mining, sentiment analysis to actually know what the consumer want and able to service the consumers effectively. So the revenue generated currently is through product sales on online marketplaces. Majority of their business is from book sales in the US. So you can see on the right side, they are available in US, Europe, Singapore, Indonesia, Taiwan, on all these marketplaces. So there are three ways that Y Ventures actually sell their product. E-commerce retailer, distributor of a third-party brand, or partnering up with brand owner manufacturers for new products and sell products as its own branded item. So we go through the macro and the industry. So e-commerce sales in US is growing at a CAGR of 15.5% over 14 years. Despite the impressive growth, e-commerce only accounts for 9.1% of US retail sales. This shows that there's a lot of improvement for room to grow. Southeast Asia B2C e-commerce is set to reach over 88 million by 2025, 8.1 times larger compared to 2017. So this shows that there's a lot of room for Y Ventures. So we'll go over the key investment thesis. Number one, the organic growth from existing publishers, additional publishers, number two. Number three, building up own branded products. Number four, e-commerce distributors of other consumer products. So right now the major supplier is Elsevier Group to the company. We expect strong organic growth after the opening up of the buy box in online marketplaces such as Amazon. So as you can see in the figure below, the buy box is actually the one-stop clicking of the, you can see as the red box there. So normally when consumers they buy items on online marketplaces, they will not go and click other sellers where it will be more troublesome for them also, and they're not actually aware that there are actually other sellers on the market. So being in the buy box essentially equates to having 90% of the sales click. So additional publishers, we expect additional publishers to use Y Ventures as the success shown in Elsevier. One of the reasons is because offline channel lack expertise and tools for online distribution. So the publishers, they are not aware of how the offline channels distribute, how they price it in the market. They have no control of all this. So the partnering of Y Ventures Group, they are able to control their products. And the other key point is offline channels do not have much access to Southeast Asia, so Y Ventures can help them with that. Next, building up own branded products. So just now, is an online retail private label brand. They use data analytics to know what consumer wants and they push it out to the market. So the product range under this brand include health, beauty, home, living, electronics, and food products. So there's another newly created brand is Fairladder, the highest funded Kickstarter launch in Singapore. So actually you can see from the back, this is actually what the consumer wants. They use sentiment analysis, feedbacks from customers to actually design this bag. So next, e-commerce distributor of other consumer products. So most of their products are indiscriminately sold online with little control over pricing, brand image. So Y Ventures, we believe, will become preferred e-commerce distributor for all these products. So these are newly acquired in Jan 18. They secured 20 consumer brands such as Lowepro, Shanti, Switcher, F&B brand. So we initiate coverage on Y Venture with a buy and a target price of 70 cents. We are pegging Y Ventures to other e-retailers from US and Europe. However, such companies can trade at 70 times to 80 times PE. Due to the smaller scale and differences in business model, we are adopting a more conservative valuation for Y Ventures. We are using a 3 times PE FY18 as our target price. So the risk factors is that online marketplaces, which I mentioned before, Amazon, have full discretion on who will be listed in a buy box. And also the Elsevier Group currently supplies 66.6%, but we believe that they will be able to secure additional publishers. And another risk factor is that Zuoquotian Trading is a wholesaler of books in major customers of Y Ventures. So we believe that with Y Ventures capability, this risk will definitely be averted. And next, I'll pass on to Teh Hong to talk about Frasers Centrepoint Trust.
Hi, good morning clients, Teh Hong here. I will go through some of the REITs which reported results last week. From my end, I have three. I have Frasers Centrepoint, I have CapitaLand Mall Trust, and I have CapitaLand Commercial. Okay, I'll start off with Frasers Centrepoint. Frasers Centrepoint for the last quarter is their first quarter of 18 because they have a September year end. For first quarter, they actually had an 8.7% increase in revenue, and that was primarily because, as you all know, North Point, the old North Point that they own, which is now called North Point North Wing, North Point City North Wing, that one, the renovations work was completed sometime in September last year. So as the renovations were completed, occupancies in that mall started to climb. So with the improvement in occupancy in NPNW, they have gross revenue growing close to 9% to 48 million. And okay, then flowing down the lines, you see that distributable income was up 4%. Is because the management fees that they collected this time round versus 1 year ago, this time round they actually collected less in units, meaning more in cash. So more in cash means that less cash will be available for distribution. And the reason why they collected more in units last year was because of the ongoing renovation works. So it was an initiative by management to try to support the DPU. So I think what you see is that over the next 2 years, you see that this percentage of management fees collected in units will actually start to gradualize and normalize to its normal level. Normal level historically has been close to 20 to 25%. So on the tenant sales front, you see that for FCT's portfolio, the tenant sales has actually stabilized. In the
in the fourth quarter calendar year last year, tenant sales was actually stable. It's in fact up 0.2% year on year. It may look stable and flat, but actually if you compare it historically, it's actually a very big improvement versus what they were seeing in the second quarter of 17. So that is in the January to March period for them. That quarter was the trough in the tenant sales, where you see tenant sales dropping close to 7% year on year. So over the few quarters following that quarter, you see that tenant sales were still dropping, but the drop has been gradually narrowing. In terms of overall occupancy, there was a slight improvement in the occupancy to 92.6%, and this primarily was supported by North Point North Wing's resumption in the occupancies after the AEI. For now, so much for the positive side. Some of the negative sides that we are seeing is, you see the rental reversions have been slowing. In 1Q18, it was actually coming in at 1% versus the whole of last year's 5.1%. And a lot of this is due to Bedok Point. Bedok Point, as we all know, has been struggling for a few years. It is still struggling, and you can expect this trend to carry on for a while more. And another negative for it is if you look at the occupancy for Changi City Point, that mall was supposed to recover after the opening of the downtown line at the Expo Station in October last year. But you see that occupancy at that mall is still hovering around 86%. Not much improvement from the quarter ago. So all in, going forward, expectations is that you can expect the ramp up in occupancy for NPNW to drive revenue going forward, but then this will also likely be mitigated by the gradual reduction in the management fees that they will take in units, like I elaborated earlier on. So all in all, we still maintain our neutral call on FCT. Our target price is unchanged and at 214. If you look at historically valuations, this is actually at quite on the expensive side of things, at a -1 SD level for use and slightly above average price to books. Next, I move on to CMT. I think generally they're facing the same story. Maybe I'll go through the numbers first. Gross revenue is flat. So for CMT, you see that rental reversions for the whole year came in at negative 1.7%. But the good thing is that revenue on the whole has been quite flat because it has been held steady by higher revenue in some of the malls like IMM and like Clarke Quay. Clarke Quay because of the ramp up in the occupancies after the AEI works. And IMM, despite the fact that this year you see that reversions were negative for that mall, but you see actually the full impact of the negative reversions coming in only next year. And for CMT, there is actually some kind of savings from lower utilities. For the entire year, utilities bill came in at about 1.6 million lower than the previous year. And that is why you see that the NPI drop actually has not been as heavy as the gross revenue. And this savings in the utilities bill, you can expect this savings to carry on for the next 2 years, because what management has done is that utilities, the portion has been hedged for 2 years forward. So even though now you see that the oil prices may be recovering, but you can still expect some kind of savings on that front over the next 2 years at least. Okay, all in, NPI margins improved because of what I mentioned earlier on, utility savings. And gross revenue stable. I'm excluding Funan because it's undergoing renovation works. And like I mentioned, the general climate for CMT and FCT is that the reversions are coming in negative because of the high occupancy costs and because of the fact that you're renewing contracts for 3 years ago. And so for the entire year, CMT's rental reversions came in at a minus 1.7%. A lot of the weakness was because of Westgate, Bedok Mall, and Tampines Mall. And so all in, we expect this kind of rental reversion pressures to continue for CMT in FY18 because of a few reasons. First, you have it that occupancy cost is at one of the highest levels in their history. You have this ongoing e-commerce threat as well as the fact that retail space supply over the next 2 years will over the next 1 to 2 years will be pretty significant in terms of your supply will be coming in the form of Jewel, Paya Lebar Quarter, and North Point City. So average valuations now, we are maintaining a neutral on CMT, our target price as we roll forward our forecast into the new year. Our new target price is 2 cents higher at 2.03. Rating will remain unchanged at neutral. And if you look at historically though, CMT actually is now trading at the cheaper side of things versus historical valuations. But we believe that this is trading at a cheaper side of things because of the various factors we pointed out, such as the high occupancy costs and the headwinds facing the sector now. Last for me is CCT. So on the office side of things, CCT had an increase in revenue of 13%. This is due to the fact that this year they consolidated Capital Green's earnings, and then they also had an acquisition in Asia Square Tower 2 in November. So these two add on to give you a 13% increase in revenue. Okay. Another thing to note is that the distributable income went up also because there was a top-up from the management, from including the use of divestment proceeds, because there was actually a loss of 2 buildings over the course of the year. So they divested 1 George Street, they divested Wilkie Edge. The new acquisition only came in November, so there would be some form of loss of income from those 2 divested buildings, and which is why there was a top-up for the loss of income. Generally, portfolio occupancy is stable, but the bright side of things is that retention rate for CCT has actually improved year on year. For FY17, I think it's doing close to high 70s%. 1 year ago, it was doing 60+%. So you can see improvements on the ground on the demand side of things. And the good news for the office rents is also that in 3Q17, you saw that the office rents rebounded for the first time after 9 quarters of decline. Now, 4th quarter, the acceleration improved. Now it's up 3.3% in 4Q. And so our expectation is that rental reversions will still carry on until at least the second half of the year. And because of the 16% appreciation in the price since our since our 3Q results report, the current price has already exceeded our target price of 180 cents, which we are maintaining the target price at still the same price. So with that, we downgrade our call from accumulate to a neutral. And if you look at historical valuations as well, CCT is at on the more expensive side of things as well. Okay, with that, I'll pass on to Richard for the other REITs results.
Thank you, Terho. Yeah, now we move on to Ascendas REIT first. As you can see, we maintain our accumulate with a slightly higher target price of 289. We are forecasting 16 cents DPU for a full year. That will be a 5.6% yield based on the last close price on Friday. For this quarter, gross revenue was higher by 4.1%. This is due to acquisitions made to the portfolio. We jump to the DPU. DPU is marginally lower year on year. That's because there was a one-off property tax refund in the third quarter last year, so that caused the DPU to be slightly higher. Also, there's a larger unit base year on year. So we look at some of the operations side of things. There was positive renewal rate of 3.1% for the total portfolio. That was led by Singapore side with 5.8%. But within Singapore, it's a mixed bag. There's some where there was positive, some negative, but overall it's positive. Australia was slightly down, -1%, only from one tenant renewal. Ascendas REIT has been quite active in their capital recycling. They have divested 84 Genting Lane, and they have acquired 100 Wickham Street, which is an office space in Queensland, Australia. They have also proposed the acquisition of a speculative built logistics property in Brisbane that could be completed by the end of 2018. The other negative thing for the results is quarter-on-quarter lower occupancy. That's marginally from 92% to 91.1%. Is this coming from both Singapore side and Australia side, having a lower occupancy quarter-on-quarter. Overall, we see a stable outlook for REIT. This is coming from contributions from the acquisitions, and this should be able to buffer the impact from their oversupply headwinds. Having said that, their portfolio is well diversified, and because there are many properties in the portfolio, they do not have a tenant concentration risk. Our target price gives an implied 1.36 times forward NAV. Next is Keppel DC REIT. We maintain neutral, target price 147, forecasting a DPU of 7.73 cents. That will give you a 5.4% yield over last Friday's close price of 143. So for the full year, there was a large increase in gross revenue. This came about from their acquisitions. That's Keppel DC Dublin 2, Milan, Cardiff, and 90% interest in Keppel DC Singapore 3. We'll jump to the DPU. So DPU was 16% higher year on year. That's compared to a 40% increase in revenue. That's due to the effect of their preferential offering that had impacted third quarter and fourth quarter 2016 DPU, and there's a one-off capital distribution that's equivalent to 0.15 cent in first quarter 2017. If you adjust all those out, DPU grew by 4.3%. Some of the positives for the portfolio is that WALE remains long at 9.1 years. This will give you income visibility. Aggregate leverage remains low, and they do not have any debt maturing in 2018. So the next tranche of debt will be maturing in 2019. With their low leverage, they have about 210 million of headroom. This based on their internal cap of 40%. Some of the negative for the quarter was that one of their key clients renewed the Gore Hill lease at a minus 4.5 reversion. The tenant was given a bulk discount because the tenant takes up multiple spaces within the portfolio and also took up more space in this renewal. Outlook is stable to positive. They have minimal leases expiring this year and next year, only 2.2% in 2018 and 2.3% of their NLA in 2019. We should see a full year contribution from Keppel DC Dublin 2 in 2018. This was acquired in late 2017 and had a partial contribution in 2017. And there will be a contribution from Main Cubes. This is their ongoing data center that is being constructed in Germany. Is expected to start contributing in second quarter of this year. The other thing is that the manager is working towards achieving its target of a 2 billion AUM this year. So you can look out for more acquisitions this year. However, the valuation is a bit rich at the moment, 1.45 times of the FY18 price to book. Next, we move on to Mapletree Industrial Trust. So we are also maintaining neutral on this. Target price 215, slightly higher than our previous target price. We're forecasting DPU of 12.08 cents. That will give you a 5.7% yield over the last close price of 212. So year-on-year revenue increased. This is contribution from the HP build to suit. Mainly this is coming from phase 2. The other new item for their results is this share of profit from joint venture. This is coming from their joint venture with a sponsor to own a platform of 12 data centers in the US, and there was a 12 days contribution from this JV in the quarter. So DPU is 1.8% higher year on year. There was an advanced distribution before the private placement, and then 1.89 cents will be distributed to the enlarged units. Some of the positives for Mapletree Industrial is the gearing remains relatively low, 33.8%. This affords them some headroom to acquire and grow the portfolio. The other update is on their Kallang AEI project. Last quarter, it was only 3% committed. Now the manager is reporting that it's been already 12% pre-committed, and they're in discussion with tenants making up an additional approximate 18%. So the manager is optimistic on reporting 30% pre-commitment by the end of this financial year, which will be March 2018. Outlook for the REIT is also stable or positive. Oversupply situation is improving with the tapering of new supply, and the Kallang AEI and the data center built to suit project will be coming on stream in calendar year 2018. So this would add on some revenue growth for the REIT. However, valuation is uncompelling at the moment at 1.48 times forward book. If you look at the chart on the right here, we have put up this is the chart showing the forward price to book, or price 12-month forward price to NAV, the historical forward price to NAV, and you can see that it's now already more than +2 standard deviation above the historical average. Okay, we've come to the end. We'll take a pause now for questions.
Hi everyone, Tehong here. We have a question. We have quite a brilliant question, and this well thought out question by our client here on FCT on the possible acquisitions of Waterway Point, because their parent has this 1/3 stake in Waterway Point. And so the question is whether there could be a potential catalyst from this acquisition, given that North Point is already restoring to full operations in FY18, and that the trust has a low gearing of 30%, suggesting that they have the debt headroom. So I guess management was non-committal on this, and I guess they cannot commit much as well. But I think it is a possibility this year, given that the parent has also just won a very huge land tender in the former Zook site. That tender is about close to $1 billion. So given that recent win by the parent, it may appear to be more possible that the capital recycling in passing on this mall to FCT may come sooner. And also it is worth noting that the FCT's gearing amongst all the retail REITs is one of the lowest, outside of SPH REIT, is one of the lowest.
Sorry, this is Linsin. So I'll be answering a question on behalf of Paul on Y Ventures. So there's a question saying that the P is now quite high at 59.2 times with the target price of 70 cents. Whether the P is way too high. If you refer to this table, right? So year zero meaning that is actually at FY 2016. This is FY 17. So if you are looking at if you are looking at FY 17 and FY 18, we're expecting a 50% growth in the in revenue. So that will trickle down to the bottom line. So if you look at our expected forward PE for 2018, it actually we're expecting it to come down or normalize to about 19 times. So we think that with our target price at 70 cents is justifiable.
There are several questions asking about China Sunsine. One is about how they will utilize the cash in hand, and whether there is any possible acquisition to utilize the cash. As of now, the management didn't disclose any plans to for acquisitions. And as for this year and last year, they mentioned that the dividend payout ratio will be more than 20%, and we expect that the money will be utilized on the existing ramp up of capacity. As of December 2017, the capex already pay out by around 60%. So the rest of the capex will be completed in this and next year. And also there is a question asking about the duration of a supply contract. There is no specific duration for supply contract because different tire producers or clients will ask for different terms. Also, there is a question asking about where China Sunsine source the raw material from. As we knew that the raw materials market, especially the aniline market, is quite fragmented. So there is no specific or fixed supplier of raw materials to China Sunsine. And one thing we know that there won't be any impact on those raw material suppliers on their ramp up of capacity, as we know that as of now the aniline market is encountering overcapacity. So that means they always can find the supply of the raw materials. Thanks. So if there are no more questions, we'll end today's webinar here. Thank you for tuning in today. We welcome you to join our webinar next week. Thank you.